U.S. banking stocks are having a field day after Morgan Stanley and Goldman Sachs reported higher than expected earnings. Morgan Stanley managed to ramp up profits in the third quarter by 20% on the year, boosting income from the wealth management side of the business, trading and investment banking. Similarly, Goldman Sachs results also beat analysts' forecasts, with equity trading offsetting some of the weakness in its bonds trading. One bitter note was sounded by BlackRock, the world's largest money manager, as the company warned that the global trade wars are causing investors to pull out of some of the riskier assets. The DJIA's EU negotiators remained skeptical about the possibility of a deal during the region's summit Wednesday, as the issue of the Irish border remains a stumbling block. Their pessimism didn't seem to slow down sterling, and the currency firmed 0.35% against the euro and 0.45% against the dollar. Oil prices static despite tensions. Oil prices have been declining for a few days now despite the looming Iran sanctions and friction building up between the US and Saudi, and Tuesday it finally became clear why. Russia's supply restraint agreement with the oil cartel OPEC, which became effective in 2017, seems to have come to an end, and the country is now pumping more oil than ever. The higher production stems from domestic requirements because the country's budget depends on the oil income, but it also partly comes in response to the lobbying from the U.S. to increase output to counteract the potential shortage that might be caused by sanctions against Iran. Tesco shares fall. Tesco is back in the limelight for the wrong reasons, as former Tesco chairman Richard Broadbent testifies at the criminal trial against two former executives this week. Tesco shares have been tainted by the ongoing trial over fraud and false accounting in 2014 and will likely remain in focus for a while, as the trial is expected to drag on into December. The retailer's shares have slipped 3.52%, leading the FTSE fallers today. ASOS remains a strong business after a bumpy year. ASOS has produced a good set of final numbers that indicate recent negativity toward the stock may have been overdone. Especially warm weather across Europe doesn't appear to have had the negative impact on sales that many in the market had feared. For the size of its profits, ASOS still has one of the highest price tags on the market, so it's not surprising to see investors get skittish at any hint of a guidance miss. But at a fundamental level, it remains a strong business with excellent growth prospects. Since it was established in 2000, ASOS has staked out a well-established brand position with geographic diversification in what remains a growing global e-commerce market. Rising competition from Amazon, which introduced its new wardrobe business last year, shouldn't be scoffed at though. So it's pleasing to see that management appears to be getting the balance right between growing earnings and investing in the product offering. Softcat remains in good shape. Softcat has fallen short of the market's lofty expectations, but the business remains in good shape. Growth in customer numbers has slowed to 4.7%, compared to 6.0% at the first half, which will stoke concerns that the group's stellar run is at least moderating. On the positive side, the amount of profit that Softcat is making out of each customer has grown fantastically. Softcat is successfully cross-selling security products as businesses become more paranoid about cyber attacks and regulators threaten harsher penalties if they don't keep hackers out. Company executives are also demanding greater storage capabilities, so they can comb vast troves of data for fresh insights into customer behavior and new market opportunities. Those fundamental demand drivers and the quality of Softcat's offering should support further growth in the years ahead, though management is hinting growth may slow this year by mentioning that 2018 conditions were exceptional.